Right now, you are quietly volunteering to hand over a massive down payment for a brand new trailer straight to the IRS every single year, simply because your business paperwork is left on the factory default configuration. If you clear less than $60,000 a year after your operational overhead, running your logistics company as a corporation will actually destroy your margins. But the very moment your net profit crosses over this exact threshold, your strategy has to completely invert if you want to protect your wealth from massive tax leaks. Today, we are stripping away the generic textbook jargon to analyze the raw back-end architecture of your cash flow, showing you the exact line where your current business setup stops protecting you and starts liquidating your capital. When most commercial drivers step off the company fleet roster to register their own independent authority, they are driven by a single intense focus, which is to maximize their gross revenue per mile. They hunt for high-paying spot market freight, optimize their routing software to cut out empty deadhead miles, and negotiate fiercely with freight brokers to ensure their equipment is constantly moving. But gross revenue is a vanity metric that means absolutely nothing if your corporate structure is leaking cash from the back office. Let's look closely at how the Internal Revenue Service evaluates your logistics earnings before we even touch the $60,000 scaling trigger. If you operate your commercial rig under a standard default single-member limited liability company, you have an entity that successfully isolates your personal savings and your home from highway liabilities. But for tax processing, a default LLC is completely invisible to the federal government. The IRS immediately classifies a single-member LLC as a basic pass-through sole proprietorship. This means the corporate wrapper does not exist in the eyes of the tax collector. Every single dollar of net profit generated by your tires hitting the asphalt is viewed strictly as direct, raw self-employment earnings. And that means the IRS instantly hits your net operational balance with a flat, non-negotiable 15.3% self-employment tax. Let's freeze right here for a second, because this is where the financial path of a wealthy owner-operator separates from someone who works until their joints are completely destroyed. That 15.3% self-employment levy is not your regular state or federal income tax bracket. That is a flat structural employment tax taken completely off the top of your net earnings before you even factor in your standard deductions, your children, or your personal household tax brackets. If your trucking business net profit sits at $40,000 or $50,000 after fuel and maintenance, you are paying that 15.3% on the full volume of your earnings. At $40,000 net, that is a $6,100 tax balance. At $50,000 net, that is a $7,600 tax balance. When you hear other owner-operators at truck stops or financial gurus online talking about escaping this cash drain by executing a subchapter S-Corporation tax election, they are only telling you half the story. They explain that by electing S-Corp status via IRS Form 2553, you can legally split your business income into an employee salary bucket and a corporate business distribution bucket. They tell you that you only pay the brutal 15.3% employment tax on your salary bucket, while your distribution bucket bypasses the levy entirely. On paper, that sounds like an absolute goldmine that should cause every single driver to run out and file this paperwork this afternoon. But here is the structural trap that the internet completely glosses over. Running an official S-corporation introduces a rigid system of compliance overhead, corporate filing protocols, and recurring accounting costs that do not exist under a standard default LLC. Before we calculate the exact dollar point where these corporate compliance costs completely eat your savings alive, drop a comment below with your current trade entity status. Let's see how many operators are currently running under a default LLC versus a formal S-Corp setup. Let's examine the actual operational price tag of maintaining an S-Corporation in the transportation sector. The moment you file that corporate election, you are legally forbidden from simply writing yourself an owner draw or transferring business capital directly into your personal checking account whenever you need cash. You must integrate an automated formal payroll processing software to manage your employee earnings. This software carries recurring monthly subscription costs and transactional processing fees just to handle your mandatory monthly tax withholdings. Furthermore, you can no longer simply file a standard Schedule C attached to your personal tax returns at the end of the year. An S-corporation is required by federal law to file an entirely separate comprehensive corporate tax return known as Form 112-O-S. Filing a Form 112-O-S requires specialized commercial tax preparation software and corporate bookkeeping integration. If you do not have a deep background in corporate accounting, you will have to hire a professional logistics CPA to review your ledgers, generate your employee W-2 forms, manage your corporate payroll returns, and prepare your business tax documents. A reputable, specialized commercial transport accountant will charge anywhere from $1,000 to $1,500 annually just to manage this ongoing corporate compliance and entity tracking. Now let's bring the math back to our $60,000 net profit line so you can see the geometric point where the corporate scale tips. If your truck is currently clearing a net profit of $45,000 a year after your diesel, tires, and broker cuts, your flat 15.3% self-employment tax under a default LLC is roughly $6,800. If you try to force that $45,000 profit into an S-corporation structure, you have to establish a reasonable W-2 salary for yourself. Let's say you set your employee wage at $30,000 based on local logistics driver driving statistics. You pay the 15.3% tax on that $30,000 salary, which equals $4,590. The remaining $15,000 moves into bucket number 2 as a corporate distribution, completely bypassing the employment tax and saving you roughly $2,295 in raw tax liabilities. But look at your operational ledger. To secure that $2,200 tax savings, you had to spend $1,200 on a corporate accountant, $300 on automated payroll system software, and pay state-level corporate registration franchise fees. Your structural tax savings have been completely wiped out by your administrative compliance overhead, leaving you with identical net cash in your bank account, but 5 times the amount of tracking paperwork, monthly processing deadlines, and corporate accounting stress. This is exactly why the $60,000 net profit line is an absolute financial law for independent logistics operators. Below $60,000 in clean net profit, the overhead of running a corporation outweighs the math of the tax shield. But watch what happens the exact moment your trucking operations scale past that $60,000 marker and hit a net profit of $100,000 a year. Under the default factory settings of your standard single-member LLC, that flat 15.3% self-employment tax runs completely unchecked across your entire volume. The tax liability on $100,000 of sole proprietorship net income is a staggering $15,300, written directly to the federal government off the top. Now, let's look at the exact same $100,000 net profit run inside a structured S-corporation wrapper. You run your payroll tracking system and pay yourself a highly defensible, reasonable driver salary of $50,000 based on corporate transport metrics. Your entity pays the employment tax on that $50,000, which equals $7,650. The remaining $50,000 of your business profit passes through your corporate shield directly into your distribution bucket as corporate dividends. Because corporate distributions are statutorily exempt from self-employment taxes, that entire $50,000 block carries zero employment tax liability. Your total structural tax bill drops from $15,300 down to $7,650. Even after you pay your specialized logistics accountant $1,500 to handle your corporate filings and spend $300 on automated payroll software, you are still walking away with a clean net tax recovery of over $6,000 in a single calendar year. That is over $500 a month in clear, unencumbered business capital that stays inside your operating account instead of leaking out to fund government programs. Over a standard 10-year horizon operating your routes, that single structural pivot saves you over $60,000 in raw cash before you even factor in the power of compounding market interest. If you take that $6,000 in annual tax savings and route it automatically into conservative broad market assets, that paperwork correction builds a massive financial cushion that can completely fund your eventual transition off the tools and out of the cab. Understanding the mathematics of the $60,000 profit line allows you to make data-driven decisions instead of guessing your way through your business development. If you are currently building momentum and sitting below the $60,000 marker, your primary operational objective should be strict cost control, route optimization, and building your baseline revenue. Do not overcomplicate your infrastructure with advanced corporate elections when your profit margin cannot support the administrative cost. Focus on your lane efficiency, protect your equipment from major breakdowns, and keep your bookkeeping exceptionally clean. But the very moment your quarterly projections indicate that your annual net profit is trending toward that $60,000 to $70,000 threshold, you must initiate the corporate transition immediately. Work with a certified transport accountant, submit IRS Form 2553 before the regulatory deadlines, and activate your payroll software. The drivers who build true financial independence in the skilled trades are never the ones who simply work the longest hours or take the highest physical risks on the highway. Longevity and wealth retention belong exclusively to the operators who treat their corporate accounting with the exact same technical precision they bring to their mechanical systems. To help you audit your current net profit metrics, track your administrative compliance costs, and determine the exact week your trucking business is ready to execute the S-Corp tax shield, I've engineered a comprehensive step-by-step free owner-operator profit matrix and tax checklist. This playbook gives you the exact calculators, reasonable salary threshold metrics, and corporate tracking milestones you need to present directly to your tax professional to seal your revenue leaks safely. Click the top link in the description below or inspect the pinned comment right now, drop your email, and download the full checklist completely for free. Stop running your transport business on factory default settings, take command of your structural taxes, drive safe out there, and build your own blueprint.